In the world of crypto, a single line of code can change everything. And when developers, miners, or communities disagree on how a blockchain should function, something called a hard fork happens. Think of it like this: a blockchain is like a highway. Everyone agrees to drive on one path, following the same rules. But then, a disagreement happens. Some want to add lanes, others want speed limits removed, and suddenly, two highways emerge, heading in different directions. That's a hard fork, a permanent split in the blockchain, creating two distinct versions of the same coin. Both share the same history, but from the moment of the fork, they evolve separately. Let's break this down and understand why this matters not only to developers and miners, but to you as a crypto investor. A hard fork is one of the most defining events in the world of blockchain and cryptocurrency. But what does it really mean? At its core, a hard fork is a permanent and major change to a blockchain's protocol, the underlying set of rules that govern how the system operates. This is not just a regular update, it's a radical transformation. And the most critical part? It's not backward compatible. This means nodes that continue to run the old software version will no longer be able to validate blocks or transactions created by those running the new version. The chain literally splits into two, creating two separate blockchains. Once the hard fork is executed, one chain continues on the old path, maintaining the legacy rules and system. A new chain branches out, running entirely new rules that aren't recognized by the old network. This results in two parallel blockchains, operating independently, but originating from the same history and block height. Think of it like this. Imagine a river that splits into two separate streams, each carving its own direction, with its own ecosystem and flow. From that moment forward, both chains can develop independent communities. They often take on different names, different market values, and different technological visions. Some users and miners may support one over the other, leading to a natural division within the ecosystem. Hard forks don't occur without reason. Behind every fork lies a complex cocktail of disagreements, innovations, and sometimes dramatic events. Below are the most common reasons why a blockchain undergoes a hard fork. One of the most common catalysts for a hard fork is a philosophical or technical disagreement within the community, particularly among developers, miners, and major stakeholders. What kind of disagreements? Scalability. Should the network support larger blocks to handle more transactions? Transaction speed. Is speed more important than decentralization? Network fees. Should fees be higher to reduce spam or lower to support adoption? Governance models. Should decisions be made democratically or be developer-led? These seemingly technical questions can lead to heated debates, often splitting communities. In 2017, the Bitcoin community split. One group believed in maintaining the smaller 1 MB block size for decentralization and security. Another group advocated for larger blocks to increase transaction throughput and lower fees. Result? Bitcoin Cash, BCH, was born via a hard fork. It wasn't just code that split. It was visions, values, and philosophies. Sometimes, a blockchain discovers a critical vulnerability, something so dangerous that it could allow someone to steal funds, let attackers manipulate transactions, or even shut down the entire network. In such cases, time is of the essence. Developers may initiate a hard fork to fix the flaw immediately, especially if a backward-compatible solution isn't feasible. Why not just patch it? Because the protocol is decentralized. No one person or entity can force everyone to update. If the patch involves changing core functions that break compatibility, a hard fork becomes necessary. The priority becomes protecting users, assets, and the long-term stability of the network. What usually happens? Developers propose a fix. The community discusses it, sometimes quickly, sometimes over weeks. A date is chosen, and the network splits at a designated block number. Users must upgrade their software to stay on the updated chain. Some blockchains reach a point where their existing architecture limits growth or new innovations. A hard fork can be used to introduce smart contract capabilities, enhanced privacy features, new consensus mechanisms, better transaction handling, or more efficient block validation. In these cases, it's not about fixing something broken, but about evolving the protocol to match the changing landscape of blockchain tech. But why a hard fork? Some of these upgrades are so deep in the system that older nodes can't comprehend them. New rules would invalidate blocks created by older rules. That's why these types of upgrades often necessitate a clean, non-reversible break. A hard fork. The new chain often becomes faster, more scalable, or more feature-rich. It may attract a new wave of developers, users, and capital. However, some purists may stick with the old chain, valuing stability over change. Not all hard forks are proactive. Some are reactive, created in the wake of disaster. The most famous example? Ethereum's DAO incident in 2016. A major smart contract exploit resulted in the theft of millions of ETH from investors. The community was faced with a difficult decision: accept the theft and move on, or rewrite history to return the stolen funds. The decision? A controversial hard fork was implemented to reverse the hack, return the funds, and resume normal operation. But this didn't sit well with everyone. A portion of the community believed that code is law and that the blockchain should remain immutable, even in the face of wrongdoing. The result? Ethereum, ETH, the new chain that rolled back the hack. Ethereum Classic, ETC, the original chain that kept the transaction history intact. Two different chains, two different philosophies. One explosive moment in crypto history. Hard forks don't just affect code, they affect users, who must decide which chain to follow. Miners, who must choose where to direct their computing power. Exchanges, who must decide which coins to list and support. Developers, who must continue innovating for the chain they believe in. Often, hard forks bring uncertainty. Will the fork succeed or flop? Speculation. Traders might bet on both sides of the fork. Volatility. Prices can swing dramatically before, during, and after the split. It's not just a technical process. It's a community-wide event that tests the resilience, unity, and long-term vision of everyone involved. In the world of blockchain, the terms soft fork and hard fork are often thrown around. And let's be real, they confuse a lot of people. But they don't have to. Once you understand the core idea, it's actually pretty simple. A soft fork is a backward-compatible upgrade to a blockchain's protocol. In simple terms, old nodes can still recognize and validate new blocks created by upgraded nodes. The network doesn't split. All participants still work on the same chain. Think of it like a gentle tightening of the rules. Everyone follows the new standard, but those who don't upgrade can still participate to some extent. A soft fork is like updating your phone's operating system. Say, from Android 11 to Android 12. Even if you don't update, your basic apps still work. You don't get the new features, but you're still part of the same ecosystem. A hard fork is a non-backward compatible change to a blockchain's protocol. That means old software cannot recognize or validate blocks created by the new software. This causes the blockchain to split into two distinct chains. One follows the old rules, the other adopts the new rules. Both chains continue to exist independently from that point forward. A hard fork is like switching from Android to iOS. It's not just an update. You need a completely new system. Apps, settings, and everything else is rebuilt around a new foundation. Now that we understand the core difference, let's look at some real-world hard forks that have made a massive impact on crypto history. These examples will show you how hard forks are not just technical upgrades. They're deeply tied to philosophy, governance, and community values. In 2017, the Bitcoin community was in a deep debate. How should Bitcoin scale to support more users and faster transactions? One side pushed for larger block sizes to fit more transactions into each block. The other side believed in Layer 2 solutions, like the Lightning Network, to scale without changing block size. The result? No consensus could be reached. a hard fork took place. Bitcoin Cash, BCH, was created with 8 Nemobai blocks, aiming for faster transactions and lower fees. This fork wasn't about bugs or upgrades, it was about ideology. One chain wanted faster transactions on-chain, the other wanted to preserve decentralization and scale off-chain. The event, the DAO hack in 2016. A vulnerability in a smart contract called the DAO was exploited, and millions of ETH were drained. The Ethereum community was torn. One side wanted to reverse the hack, return the funds, and move forward. The other side believed code is law. No matter the consequences, the blockchain's history should remain unaltered. The result? Ethereum, ETH. The chain that reversed the hack. Ethereum Classic, ETC. The chain that preserved the original history. This hard fork was born out of ethics and values, not just code. It created 2 thriving chains, each with its own community, vision, and momentum. Unlike Bitcoin or Ethereum, Monero's hard forks aren't rooted in conflict. Why does Monero fork often? To improve privacy algorithms, to stay resistant to ASIC mining, and to add new cryptographic protections. These forks are scheduled, with most of the community agreeing on the timeline and purpose. Not all hard forks are dramatic. Monero shows that forks can be a routine part of evolution in a protocol's lifecycle, especially for privacy-focused coins. Okay, now for the part that really catches everyone's attention. What happens to your crypto assets during a hard fork? Before the fork, both chains share the exact same history. Every transaction, wallet, and balance is identical. Once the chain splits, your wallet address is duplicated across both chains. If you had 5 BTC before the fork, you still have 5 BTC on the original chain. But now you also have 5 of the new coin on the new chain. Think of it like this. It's as if your wallet was cloned at the moment of the split. Now you hold coins on 2 different realities, each with their own rules and value. Not at all. Even though you receive an equal balance on both chains, their market value can differ dramatically. Factors that influence value include community support, developer activity, exchange listings, use cases and adoption, and hash rate and security. For example, BTC is far more widely adopted and holds a significantly higher value than BCH. ETH has the majority of dApps, DeFi, and developer support, while ETC is more of a legacy project. After a fork, most wallet providers and exchanges will guide users on how to access new coins. You may need to import your private keys or use specific wallets that support the forked chain. However, if your coins are on an exchange, you're at the mercy of whether that exchange supports the forked coin. If you control your own wallet, you typically have full access to both versions of your funds. Hard forks can be both an opportunity and a risk. Potential upsides include receiving coins on the new chain, which could gain value, and forks often bring speculative excitement. Prices may surge temporarily. Potential downsides include confusion over wallets, networks, and scams. One of the chains might lose support and become valueless, and developers may abandon a forked project if the community doesn't rally behind it. It's essential to do your research, understand the reason for the fork, and follow credible wallet or exchange instructions. Hard forks can mean massive volatility and opportunity, but also risk. Here's what you need to keep in mind. Opportunities include market reaction, where sometimes the new chain gains traction and delivers massive gains, and early adoption, where if you believe in the fork's vision and tech, you can get in early before the crowd. Risks include chain confusion, where wallets and exchanges might not support both chains, leading to loss of access, replay attacks, which is a risk where a transaction on one chain is replayed on the other, causing accidental loss of funds, and scam forks, where not every fork has a solid dev team or community. Some forks are created solely to confuse investors or exploit hype. Exchanges usually issue announcements before a hard fork. They might temporarily suspend deposits, withdrawals, snapshot balances before the fork, and decide whether or not to support the new chain. But here's the thing. Support isn't guaranteed. If the fork chain doesn't meet certain criteria, exchanges might not list it at all. Always stay updated with your exchange's official announcements and policies during these events. From a tech angle, a hard fork is more than just flipping a switch. It involves modifying the blockchain protocol's rules, testing the new code thoroughly, coordinating with miners, nodes, and the community, scheduling the fork block, and ensuring post-fork stability and compatibility with wallets and services. One mistake in this process can result in chaos, like buggy chains or vulnerable code bases. That's why many hard forks take months of preparation, communication, and testing before going live. Crypto isn't just technology, it's philosophy, economics, and power. Hard forks often expose deeper conflicts in crypto ecosystems, such as who controls development, whether decentralization should be absolute or practical, and if users get a say in protocol upgrades. Some forks happen because power struggles break trust within communities. Others happen when a minority group feels silenced and wants to express their vision through a new chain. In many ways, hard forks are democratic rebellions. They give people the choice to walk away and build something different. It depends. Pros include allowing innovation without central authority, giving voice to minority opinions, and offering a fresh start from problematic history. Cons include confusing new investors, creating brand dilution, and sometimes dividing communities irreparably. But overall, hard forks represent what makes crypto unique: freedom to innovate, even if it means breaking away. As blockchain governance evolves, some projects are moving toward on-chain voting and decentralized consensus to avoid contentious hard forks. But forks will likely never disappear. They're part of crypto's DNA, serving as a pressure valve when consensus breaks down. Even Ethereum's transition to proof of stake had people debating whether a hard fork would split the chain again. Some miners even tried to launch a proof of work fork post-merge, but it didn't gain much traction. So yes, hard forks are still relevant. But now, the community is more cautious. After witnessing dozens of forks over the past decade, the crypto world has become better at evaluating whether a fork is worth supporting, or just noise. If you're serious about crypto, you need to understand hard forks not just as tech events, but as market-shaping catalysts. Here's what to remember. Always track fork announcements from official sources, secure your private keys, evaluate the fork's vision and team, be cautious post-fork, and don't chase every fork. Focus on quality, not quantity. Many forked coins fade into irrelevance. Hard forks are the blockchain's way of saying, we don't need to agree, we can build our own future. It's a wild, raw, and often chaotic process, but it reflects the spirit of decentralization and open innovation that defines crypto itself. So next time you hear about a hard fork, don't just ignore it. Look deeper. It might be the start of a revolution, or just another flash in the pan. But either way, it's a signal worth paying attention to. If you found this episode helpful, make sure to like, subscribe, and turn on the bell icon, because we're dropping deep, real insights into crypto every single week. Follow us on X, YouTube, Medium, Instagram, and Threads at True Crypto Insights and Crypto Tribex for podcast. See you in the next one. And remember, in crypto, knowledge is your best asset. Hard forks in crypto. Explained, the truth they don't tell you. What's a hard fork? It's when a blockchain splits into two paths, each following a different set of rules. Kind of like a tech divorce. Why do they happen? Not just bugs. Think of deep disagreements over the future of a project. Vision clashes, security fixes, new features, and reversals. Here are 3 forks that shook the space: Bitcoin to Bitcoin Cash, Ethereum to Ethereum Classic, and Monero upgrades. When the chain splits, your wallet gets copied. You now hold assets on both versions of the blockchain. But heads up, value and support won't be the same for both. Soft fork versus hard fork. Soft fork means old systems still work. Hard fork means total split, new system needed. Forks are growing pains, sometimes messy, sometimes necessary, but they always shape the future. Follow us on X, YouTube, Medium, Instagram, and Threads at True Crypto Insights and Crypto Tribex for podcasts for deeper breakdowns like this.